whilst that I can just run through a couple of housekeeping issues whilst people are still joining. If you have any questions for Arthur, please raise the hand icon on your screen, and we'll pass those on to Arthur. Otherwise, if you do have any questions after the session, please feel free to email me, and I'll happily flick those on to Arthur as well. Don't forget that our sessions are also on YouTube, on our YouTube channel. So if you do want to catch up on any of the webinars that we have hosted to date, alternatively want to watch what Arthur has to say again, please go and take a look there. So welcome again, everyone. Arthur, I think you can just put your camera on so that we can see you for a moment, if you don't mind. Welcome, Arthur. Great to have you joining us again. I've just done the welcome, Arthur, and I'm about to do the introduction to you. Arthur did tell me before we went on air that any difficult questions he'd ignore. So I'll make sure to filter those properly for you, Arthur, before I pass them on. Let me quickly do an introduction. Arthur and I have traveled quite extensively, most recently to Botswana. Hello to everyone in Botswana that's joined us. Arthur, always a pleasure and a privilege to welcome you back to this forum. Arthur's an old friend of the business. Arthur has worked in the investment industry for more than 20 years. He holds an honors in B-Econ Economics, cum laude, from the University of Stellenbosch in South Africa, and an MSc Financial Economics degree from the University of London. So Arthur, you've got your hands full today. It's been a roller coaster ride this year, and I guess you're going to be staring into your crystal ball. And if anyone's watching this in 2024, we can see how accurate you are with what you're thinking and where you think the currencies are tracking. So Arthur, over to you. Thank you once again for making time, and yeah, much appreciated.
Hello, Mark. Hello, everyone. I hope everyone's well, and thank you very much for that kind introduction. I'm going to try and share some slides here just to kick us off, and hopefully that is showing. Please let me know if it isn't.
I can see you, Arthur.
Okay.
Give it a second.
Can you see, it's not the slides?
No, nothing yet.
Okay, so maybe I'll just try that again. Let me see here, share screen. Hopefully that should be showing.
Happening. Yeah, it's on. It's on, Arthur.
Okay. All right. So we're up and running. Okay. So we're talking currencies today. So, currency outlooks come with a lot of health warnings, simply because, I mean, at the end of the day, they are very much a reflection of underlying conditions in economies. And especially when you're looking at emerging markets, but also developed markets, of course, they're being influenced continuously by fairly large shocks, unexpected events, and things can change quite quickly. But you do have to try and figure out some kind of framework to work with, to give you some idea as to what is a reasonable outlook for the currency based on current information, and where you reasonably expect some of the bigger trends to go forward. And we tend to try and take fairly long-term views, try and figure out structurally whether currencies are heavily undervalued or overvalued, which at least gives you some sense of comfort if you're taking a position. But then also, obviously, we try and take a view on where economic variables will be tracking and how they will influence things. So currency forecasts come with a high, with a health warning. At the end of the day, forecasting the future is fraught with risk. But nonetheless, if you at least look at it from the perspective of structure and have some sort of structural framework in place, that it is helpful. And you will find as we go along, one of the structural frameworks that we use is purchasing power parity. I know people don't like that sometimes, but when we do our work, we don't rely on a particular base year where it's very difficult to pin down what an actual equilibrium year is. But what we do is we use best fit models. At the end of the day, though, if you have relatively open economies that trade with the rest of the world, then it seems reasonable to expect their currencies over the long term to move in line with inflation. So inflation remains one of the most important indicators of where currency is going long term. Bottom line, if you have high inflation in an economy, your currency is worth less and therefore should depreciate over time. In the near term, though, we get a lot of influences, cyclical influences, and one of those is interest rates. Interestingly enough, of course, central banks raise interest rates to cool economies down, to get inflation back under control and back towards their targets. So it's all intertwined with the long-term inflation outlook. But in the near term, of course, these interest rate moves can be quite significant. And as we've seen again over the past year or so, the Fed matters. We've made this point a number of times in the past, especially for emerging market economies. When the Fed is raising interest rates, very often the dollar is strong. When the dollar is strong and global financial conditions are tightening, that normally spills over negatively onto emerging market currencies and interest rates. So we've been through this patch now of a substantial amount of Fed tightening. So the left-hand chart here shows the blue bars, which is the Fed funds rate. And you can see it's been a very sharp jump in a very short space of time compared to previous interest rate hiking cycles. So they've gone a long way, and arguably they're now in significant tightening territory. At the same time, of course, the desired response, which is what the Fed is looking for, which is a looser labor market, higher unemployment, which would then give some sort of indicate or comfort that wage growth should moderate and start lowering the risk of any potential wage price spirals, although I don't think that there is one in the US, but give some sort of comfort that wage growth per worker will slow to a level consistent with the inflation target. So, at the end of the day, the question is, have they done enough? And if you look at the forecasts of the FOMC committee recently, the median forecast of the participants in that committee meeting, they actually indicated another more interest rate hikes, another 50 basis points by the end of the year. But at the same time, looking forward to the end of next year and the year thereafter, those numbers should read end of 2024, end of 2025, not the first month. They've got interest rate cuts coming through. So I think, it's debatable as to how much they need to still raise interest rates and whether they will still need to raise interest rates any further. That will still influence currency markets in the near term. My suspicion is that they must be at or very close to the top, maybe another 25 needed there. But the point being, after that very sharp rise, we are approaching the top of the interest rate cycle in the US, in my opinion. And with interest rate cuts moving through into next year, that becomes a somewhat more favorable environment, in my view, for EM currencies. So that's point number one. Still remains a very important influence. Also, we'll get back to this relative to the majors, the euro and the pound, what that means. So, to be confident that we're at the top of this US interest rate hiking cycle, because if I'm going to argue that we are nearly there, if not there already, and that if we have interest rate cuts next year, that's quite a relief for emerging markets, then you've got to argue that inflation is actually going to behave relatively well going into next year, and that slight easing or the thawing of inflation that we've begun to see, especially core inflation in the US, will then continue, and significantly so into next year. So one of the issues, of course, has been that during the pandemic and after the pandemic, we had these enormous global supply side disruptions. This is an index put together by the Federal Reserve Bank of New York, and it's simply a catch-all indicator for supply side disruption. So they look at a range of indicators, from order backlogs to prices paid, prices received, freight costs, whether they be by sea or air, a whole range of indicators that they then gel into one and then plot that as a standard deviation from the long-term average. And you can see there we've shifted up to 4 standard deviations from the long-term average by December or late 2021, early 2022, which was, which indicated obviously a high degree of supply disruptions, but that's now completely faded and has started going the other way. So from this indicator, it would seem fair to argue that global supply side disruptions are fading quite fast. And we've seen that in goods price inflation, particularly also in the US, where goods price inflation has been lower, significantly so than services price inflation. Of course, as we have the rebound in services activity, as people become more comfortable with the pandemic having been declared, at an end, not that there aren't still infections being recorded, but so that's obviously resulted in a rebound in services activity. There's some pressure still related to that, but I think that once that also starts to normalize, hopefully, along with hopefully lower rents inflation, that would feed through into lower services price inflation in the US and provide the Fed with more comfort. Of course, the thing that the Fed does worry about is the fact that they don't have enough people in the US. So what this chart shows you is the blue line is the total number of people employed in the US plus all those jobs that they cannot fill. And one can see there that far outstrips still the actual labor force. So bottom line is they don't have enough people to fill all the jobs. And that's what's been keeping that unemployment rate so low. And that's what's been worrying the Fed, and as earnings per worker have been elevated above what they would consider consistent with their inflation target. But without going into all the bottom line detail, high frequency detail, there are indications that that situation is beginning to thaw as well. And also one of the indicators would be initial jobless claims last couple of weeks being quite significantly higher. So, we think that over time, slowing labor market. The other thing about the labor market is I think one of the issues in the US is that if you're going to have a shallow recession, so people talk about recession, some people say no recession, and those who talk about recession, a lot of them are talking about shallow recessions. So if that is your outlook, then in a backdrop, against the backdrop of where there's a general shortage of labor, you'd be less inclined to retrench workers because you'd be somewhat afraid that you can't hire them back later. And that might be behind one of the reasons why this labor market has remained so tight. But again, without going into all the high frequency data, I'll show you a chart in a second as to why I think that there will in fact be quite a significant slowdown in the US, if not recession, and we should see this labor market loosening up and giving the Fed more comfort. In fact, here is that chart that I mentioned. So I'm sure that you've seen this before. It's quite a popular chart. It doesn't guarantee that you will have a recession, but you can't ignore the fact that historically, when you have had the 10-year Treasury yield trading well below the 2-year Treasury yield for an extended period, you've ended up with a recession, and those are the people would argue, and correctly, I would think, that you don't get quite the same amount of information from the yield curve as you used to before the global financial crisis, but this is still very hard to ignore. And I think a combination of this, plus, although it seems like the bank system is steadying after that serious wobble we had a couple of months ago, I do think that as banks try and preserve liquidity, that also credit extension will be quite weak. And so I think that I'm still of the view that this economy is going to slow quite significantly later this year, heading into next year. And of course, that should then also coincide with the top of the US interest rate hiking cycle. Right, so I've spent a lot of time trying to convince you that we're near close or near the top at or close to the top of the US interest rate hiking cycle, but it is important and it does filter through into the general currency outlook, certainly in the near term, including emerging markets. Right, so here, I mentioned earlier that we use, one of the things we use as a structural backdrop to figure out where currencies are going longer term is PPP. Now, in this case, at least what it does do is give you a sense of under or overvaluation of the currency. And from this, it would seem to us that the dollar is certainly still significantly overvalued. Now, a year ago, if you'd been listening to us, we would have said the same thing. We would have said the dollar's overvalued, the euro is undervalued. But also what we would have said to you, and we're still saying, is that it's not necessarily true that the dollar is heading for any kind of crash anytime soon. It will probably, in our opinion, have a weakening bias. Now, you can see if you'd listened to us a year ago, it actually strengthened for a bit before coming back to more or less the same level as it was a year ago. And we did mention back, if you'd listened to us back then, if you were in one of our presentations, I think we would have been saying, yeah, have a weakening bias, but probably its strongest period was behind it, especially as the US interest rate hiking cycle starts to peak. Now, it's not very heavily overvalued, only a standard deviation. So, as that goes, it's not a very large overvaluation. And we think, although it might have a weakening bias over the next couple of years, it's not going to be a sharp fall. Why would we say that? Well, if you look at all the arguments as to why the dollar should be weak, monetary policy is one of them. But effectively, even though the US interest rate hiking cycle is topping out, yes, the euro, the ECB will probably hike rates a bit further, but they'll probably be cutting interest rates next year too. The same goes for the Bank of England. And also, yes, we're probably moving towards shrinking of the greater shrinking of the ECB balance sheet. But then again, as far as the dollar goes, the Fed will be doing the same thing. So essentially, there's not much to differentiate in the monetary policy front, I don't think, over the next year or so. Another argument is that the dollar could, and this is a more structural argument, and we've heard it more and more, is that the dollar could lose its place as the reserve currency of the world. Well, I think that is a very long way off. Ultimately, it is still the world's largest economy. And very importantly, of course, if you look at the alternatives, one would be the euro area. I think that the euro would only become a viable alternative once you are more comfortable with a fiscal union being implemented in the euro area and completely removing disintegration risk. Although obviously that's not necessarily high at the moment, it does lurk there in the background that over time you will have to move to, in my opinion, something of a fiscal union to ensure long-term stability. As far as the renminbi goes, well, you need a fully convertible currency. So you can't have controls in place and it be the reserve currency of the world. Although to some extent the renminbi will gain ground as more and more trade occurs, obviously with China. But at the end of the day, US being the world's largest economy, highly innovative economy, and also it has that convertibility factor, and of course the liquidity premium I don't think is going to go away anytime soon. One could argue that reserves are US reserves at central banks, and that we are holding less, that the allocation of foreign exchange reserves to dollars is declining. But one must also remember that the returns on those reserves are relatively low, and increasingly what we've seen countries do is allocate more to sovereign wealth funds, and obviously those sovereign wealth funds invest in bonds and equities, of which US markets are a large share. And if you take that into account, then certainly the dollar is still easily maintaining its liquidity premium, and I think that will last for a very, very long time still, in my view. But nonetheless, weakening bias, but not a sharp deterioration, I don't think, in the dollar. And the same goes for pound sterling against the dollar. Pound sterling is more undervalued than the euro against the dollar, quite substantially so, in fact. That economy, high inflation, which is struggling to contain, not great growth prospects. Yes, and we've talked about monetary policy, but at least what you have here, some comfort that you are buying quite a cheap currency, which gives you some relative support, and perhaps this will also gain some ground against the dollar over the next year or so. But both of these arguments are mainly valuation arguments, and at least the significant extent of undervaluation gives you, in our opinion, some comfort there. The losing currency amongst all of this, although that's probably the wrong word, the depreciating currency, likely depreciating currency amongst all of the majors, is probably the yen, though, where there's not too much appetite to, it would seem, to tighten monetary policy very strongly. Okay, so that's just a quick backdrop of what we think the general movements will be in the majors. In terms of the emerging market currencies, we're going to chat about three today. One's the rand, the other one the pula, and then also the Botswana pula, and then also the Kenyan shilling. Okay, so the rand is very weak, and it's basically at more than, in our opinion, 3 standard deviations away from what we would consider its PPP value, or in inverted commas fair value, and it's had quite a torrid time of it. So from a long-term investment perspective, the way we view it is, given that this is one of the frameworks that we use, we would say that we expect the rand to be on an appreciating trend over the next couple of years. Obviously not in a straight line, and obviously there are significant risks which we must discuss, which you must take into account, and obviously you'll take your own personal view on that. But okay, the currency is cheap. Now that is helpful, because historically it's not necessarily been too much cheaper than this. Certainly at this level, it's well off the sort of 19 rand 70 odd to the dollar that we had a while ago, or close, not too far from 20. That was sort of as undervalued as I've seen it in a very, very long period of time. It's done something of a recovery since then, and possibly on the back of lower levels of electricity load shedding. Right, but you'll say to me that this is all good and well for the long term, but don't you have something that at least gives us some better idea of what's happening in the near term? And we ran a little regression just to sort of get an idea of what is driving the currency away from at PPP level. Now, in the case of the rand, the thing that most often commodity prices, right? So A strong rise in commodity prices would tend to firm up the real exchange rate, and therefore you would have a stronger currency relative to PPP and vice versa. And what we've had is declining commodity export prices on the back of what I would assume had been slower global growth expectations. But it wasn't the only thing. So we built this little model, and what we found was that over and above inflation differentials, what was explaining the value of the rand, and just bear in mind that the axis here is put in log form, so that's why it doesn't equate to the normal rand dollar exchange rate that you know. Over and above inflation differentials and the terms of trade, in other words, commodity prices, we found that there was, obviously the interest rate differential between South Africa and the US was one explanatory variable. That was important. And then another one we found was actually load shedding, electricity load shedding. And we found that each stage of load shedding in South Africa depreciated the rand by about 2%. So having come from load shedding stages of around 6 to where we are now, which is relatively low stages of load shedding, although there's no guarantee, obviously we stay here, that's explained in our view, a very large part of this retracement that we've seen, apart from the fact that the currency was, of course, extremely cheap. Right, so what you need going forward for the rand to push towards its PPP level then is better behaved electricity supply, a peak in the US interest rate hiking cycle, stabilization, and hopefully maybe even some improvement in the terms of trade. Those are the kind of factors that you would need to get the rand back then towards its PPP level. That's viewing it from one perspective. From another perspective, and that is how we at Sanlam Investments view the currency, and that is our overall view of the currency direction in the next couple of years. But we have to be cognizant of other developments. And from another perspective, this is one of the most critical things I think facing investors in South Africa currently, is to understand that we've moved away from an era where we were used to significant, sustained, positive capital inflows. So the blue line here is South Africa's financial account. That's all the investment through foreign direct investment, portfolio investment flows, loans, all those investments lumped together, expressed as a percentage of GDP, and you can see they were substantially positive for a significant period of time after the mid-2000s. What we had was obviously a sharp fall off during the pandemic and something of a recovery, but you can tell that the overall direction of this has been downwards since around 2014-15. And we wait to see the latest quarterly bulletin, which will come out later this month, as to what happened in the first quarter of this year. But nonetheless, it's quite clear that that trend is substantially weak. And why is that important? Well, that's important because as soon as South Africa wants to grow, it invests more than it saves. And the difference between savings and investment is the current account balance by definition. So when we grow, typically we run a current account deficit, but we can't grow and run that current account deficit if there are no capital inflows. And so what we've been up against is a classic balance of payments constraint, where the downturn in the terms of trade outweighed the weakness in domestic demand because of the downturn in the economy. We ran a current account deficit. It's been a bit smaller in the first quarter, but nonetheless, capital inflows have not really been sufficient to cover it. And that's also been a lot behind the weakness in the currency. Now, one of the issues that this is related to, of course, is, and a lot of commentators have said, is geopolitical risk. And obviously, South Africa's stance on Russia has also been under focus here. So, first of all, I'd just like to point out that geopolitical risk has been with us, since, well, in this chart, since so for a couple of 100 years. If we look back to the beginning of the century, well, let's make it 100 years. Let's look back to the beginning of the last of 1902. So more than 100 years of data here. And obviously no surprises there. So this is an index put together by Caldara, and I hope I'm pronouncing it correctly, Iacovelio, of the Federal Reserve Board and Princeton University. It was published by Princeton University Library Press. It's an index that takes into account, it's based on newspaper reports and the number of times that geopolitical risk is referred to, and also related words. So related words will obviously be war, etc. And you can see, just so it gives them a fair, I think, because at the end of the day, one's perception of geopolitical risk is a personal judgment. And I think that personal judgment is probably reasonably reflected in the press, if it's open, free press. So we can see here, going back, World War I, no surprise, World War II, and then all those wars, the Korean War, Vietnam War, you might remember the Cuban Missile Crisis, early 1960s, then the Persian Gulf War and the Iraq War, and interspersed there the obviously events of 9/11, World Trade Center. And then we can see the Ukraine war over there. Now, quite clearly, it's been a spike in geopolitical risk. But the point being here, it hasn't been, excessive relative to the history that we've seen of geopolitical risk. Obviously cannot be ignored. Obviously, is a very serious development, but has receded since. So there was the initial, obvious spike in geopolitical risk, but it's receded since. However, what is important is that there has been an underlying shift in capital flows within what does seem to be the realignment of geopolitical, or there seems to have been a geopolitical realignment around the world, we're obviously aware of. And this from the IMF just gives an indication. They put together a geopolitical risk index, which they then just plotted against interest in reshoring. Reshoring, obviously, just trying to bring businesses back home because you're concerned, especially among strategic investments, that you'll be missing out on a product if you can't get access to it because of geopolitical risk. So you bring that production back home. And one can see here with the US-China trade war, we started to see something of a pickup, but especially during COVID-19. And then now with the Ukraine war, we've seen this coming through quite strongly. And it's especially in strategic type investments. When I say strategic type investments, a very good example of that would be semiconductors, for example, which is used in so many things and is so important generally to economies. And we can see here in terms of the number of FDI investments into strategic type products, as I say, including chip making, it's shifted away from Asia, especially China, and back towards especially the United States. So this is an indication of something of a realignment of global FDI, in other words, capital flows. And the risk here, of course, is that if this were to escalate, that it starts to spill over into capital flows more generally, other than just strategic investments. And why would that be important to South Africa? Well, as I've indicated, we're a capital scarce economy. So capital scarce economies in this type of environment, whichever a geopolitical alignment or your perceived alignment with a particular geopolitical grouping could influence capital inflows quite significantly. In South Africa's case, just to point out where our foreign liabilities lie, in other words, where our sources of capital are. Latest data we have is at the end of December 2021. Hopefully the new quarterly bulletin will give us the 2022 data, but you can see here that mainly the sources of capital from the USA and the UK. In fact, if you take the USA, the UK, and Europe together, the rest of Europe together, well, that's just overwhelmingly actually most of where our foreign liabilities lie. And you can see from the right-hand chart a very high percentage of GDP, whereas significantly less capital comes from China, India, and Russia. So this puts South Africa in a unique position because our capital historically has come from Europe, the US, but increasingly our trade is obviously shifting towards China and the BRICS. So China and the BRICS very important from a trade perspective, but Europe and the US very important from a capital supply perspective. So you can just think in terms of geopolitical alignment. We obviously would like to remain aligned with both groupings, if it is so that we are getting this geopolitical realignment, which will continue, although of course it will ebb and flow, and we've seen already the US and China talking recently again. So hopefully that thaws, but it is something to watch. Then in terms of South Africa, one thing where this has already shown up, I'm not saying this is because of geopolitical alignment, this is more because of fiscal policy. I think that's just proving to be unsustainable. We are finding that investors are investing far less in our bonds. So this is the percentage of bonds held by non-residents versus local investors. And you can see here we went from 40% in early 2018 to about not much more than 25% as far as non-resident holdings of government bonds are concerned. So that is something of an issue. Now, of course, what it does also imply, though, is that that's a relatively lower much lower holding of bonds by foreign investors. So that might, in fact, going forward, mean somewhat less pressure on the currency from this source. We'll have to wait and see. So as far as the rand goes, yeah, I've tried to build an argument. We think it's cheap. What is happening here is that the currency had to weaken and interest rates had to go up. Because we weren't attracting enough foreign capital inflows to cover the current account balance. So the weaker currency plus higher interest rates actually improves the current account balance again. So on a one-year view, I think that the current account balance could surprise positively. And along with that, the currency should be relatively firmer. And obviously, as that happens, inflation should be lower, allowing the Reserve Bank to cut interest rates. And that's my core view. But there is this other view that we do obviously need to remain aware of geopolitical realignment issues. We've heard about the threat of sanctions against South Africa. We think that there's a low probability of that, very low probability. Probability is not null, but we think it's very low. Of course, if that were to occur and we were to have financial sanctions, as the Reserve Bank warned in its financial stability review, one's got to be aware that potentially it's not impossible that we get secondary sanctions imposed on us, although obviously they're highlighting it as a risk, not as a forecast. I have to stress that. That would be a different environment. Then we would need to reassess. Okay, so where does this leave Botswana and Kenya, the Botswana pula and Kenya shilling? Okay, just broadly, I've made the argument that the US matters, the Fed matters. Higher interest rates in the US quite clearly matter, and we've seen that over the past year, and this is reflected in what is now quite high yields on African Eurobonds, high spreads over US Treasuries, as well. At the same time, obviously, that's put upward pressure on domestic interest rates in countries on our continent, and also significant downward pressure on their currencies. But one of the things that, so just before I get there, just from the perspective of, again, fundamentally, looking at the Kenya shilling. So I think many of you maybe listened to us in the past would be very well aware that for a couple of years now, we argued that the Kenyan shilling was overvalued and that over time would weaken. And now that has happened. Left-hand chart there, our good old PPP line versus the actual dollar Kenyan shilling. But now something has happened that's quite interesting and obviously somewhat worrying, and that is that it's depreciated quite sharply of late over the past year or so, and significantly weaker than what we would pin as being fair value, which immediately tells us we've got to start paying attention to what's happening, because it's not just, you can't just rely here on inflation differentials to figure out where we should be at. And at the same time, it's always a flag to me. It's something that I watch with all currencies is foreign exchange reserves. If foreign exchange reserves are falling substantially, unabated, and there's liquidity pressure in the currency market, then I'm always more concerned. And that is what we have seen. And that's why I started off a little discussion on Kenyan shilling and Botswana pula with the Eurobonds table. Because what also has happened in a number of countries on our continent is that quite a high level of debt is in foreign currency. So in Kenya's case, a lot of the debt is concessional from multilateral organizations at low interest rates. But of course, the issue is you still need the dollars to pay back those bonds. And in Kenya's case, there is the concern about the Eurobond next year. That's due $2 billion due next year. And if you look at Kenya, what we've seen in the market over the last while is basically no access to international funding markets, weakening domestic funding conditions, and also obviously that concern about that $2 billion Eurobond that must redeem in 2024. Now, yeah. What is very helpful, of course, is IMF assistance and also World Bank assistance. So we have to say that up front, and I think that's going to make a significant difference. But I don't think that it yet solves the issue. So Well, let's just deal with that first. I mean, there's a number of support mechanisms, but it's mainly through the extended fund facility and the extended credit facility supplied by the IMF. And there's an immediate access, I think, probably coming up now in July of $410 million. But there's also further, the IMF was announced further augmentation of access under that facility. Also an extension of the duration of those arrangements, the ECF and the EFF until January 2025. And then also we're looking at the potential for a new 20-month resilience and sustainability facility with access to 75% of quota for Kenya. So all of this is significant support, also including obviously World Bank support. I think that's up to $1 billion of budgetary support. So there's quite a substantial amount of dollars then coming from these multilateral organizations that will be very helpful. My concern, though, is that if you do look at Kenya's overall external funding requirement and also its public debt and its debt servicing requirements. The bottom line for me is that if you look at the fiscal consolidation that is beginning to gain some momentum, if you look at the level of debt, which is high but not excessively high, one would say at just below 70% of GDP, and expected to stabilize there and perhaps even improve over the next couple of years, given expectation of fiscal consolidation. The problem is more on the balance of payments side and more of a liquidity issue. As I said, you can also have concessional debt, but at the end of the day, you need the dollars to pay back that debt when it's due. And that's where the issue lies. So if you look at debt sustainability ratios of Kenya, and you start looking at, you can look at total debt to GDP, as I've indicated, it's above the IMF threshold, but not that excessively high. If you look at the primary budget balance, it's shifting into a position now where it should be sufficient to stabilize the debt ratio. And so I'm not overly concerned about that. But where the concern does come in, if you look at certain of the indicators relating to the balance of payments, like external debt to exports, very high ratio there. Also, just debt service overall, to exports, and then also external debt to exports, those ratios particularly high at the moment. And also, we have import cover with those declining foreign exchange reserves that has been declining quite significant and is not too far off the benchmark 3 months worth of imports. So if you look at the funding requirement going forward, I've mentioned that $2 billion Eurobond due next year. And if you look overall at the current account deficit plus the amortizations, then the external financing requirement is going to be quite heavy in 2023 and 2024, going up quite substantially from 2022. So a gross external financing requirement going from, in the region of $6.6 or so billion last year to, I think, more than $7.5 billion this year, potentially, depending on the current account deficit size. And then also, which is expected to remain large at 5% of GDP. And then next year, even higher external financing requirement, $9.6 billion. So, or let's call it $9.5 billion. So, that's quite a lot of dollars that you need. And yes, the IMF and the World Bank are going to be very helpful in that context, but you will still need a significant amount of private sector borrowing in foreign currency to complement that and to make sure that your foreign exchange reserves don't fall to levels where you start struggling with import coverage ratios, etc. And even then, if you have a fairly significant amount of private sector borrowing, the risk is that those foreign exchange reserves could continue to be depleted. So what you hope for here is that IMF assistance and World Bank assistance crowds in the private sector effectively. But we'll have to wait and see whether that's the case. So this is, although the currency therefore is undervalued in my view, I've still got some reservations around this external liquidity. And I'd like to see a little bit more concrete evidence that we're going to see the private sector being crowded in before I'd be comfortable that the Kenyan shilling could appreciate materially. So I think there's some comfort in the fact that it is undervalued. It has depreciated quite a long way, and I would expect and hope that further depreciation is more limited. But couldn't expect any near-term strong appreciation that is sustained until we're more comfortable with the external funding, and there the private sector is going to be critical. So just to make the point that generally with African Eurobonds, one of the issues that you have to watch, not just in Kenya, but in countries across the board, is that they're quite significant funding requirements and redemptions coming up in the next few years. And you can see there Kenya in next year's that 2 billion, and then again, a little while out in 2027, 2028. So it's always something to bear in mind when one is looking at these currencies. And obviously what one would like to see is potentially a lower level of foreign currency borrowing, although for development purposes, of course, the multilateral organizations do play a very important role with concessionary funding, but one must make sure your balance of payments is sound to meet those redemptions when they are due. And then just finally on the Botswana pula, right? So, I mean, we know that the crawling peg, the downward rate of call, has been adjusted now to 1.51%. So that shows confidence that the central bank thinks inflation is going to slow quite materially into next year. I think that's a reasonable assumption. So they've adjusted that downwards to 1.51. And if you look at historically, if you look at just the right-hand chart, the dollar pula and the dollar rand, they tend to move pretty much in unison, but you do get periods of extreme rand weakness from time to time. Very liquid currency tends to be quite volatile, and then in an environment where, and I've tried to build an argument that yes, the dollar is not going to be a weak currency, but could have a weakening bias and valuation. You'd expect both the pula and the rand to appreciate against the dollar, but typically when the rand has fallen such a long way and is so cheap, the appreciation of the rand tends to be stronger than the appreciation of the pula against the dollar, just shown here as indices on the right-hand chart. So expectation is that both the rand and the pula will strengthen, but that the strengthening of the rand would probably be much more significant over the next year or two. So with the pula final chart, one would always be watching. One of the key issues around the crawling peg, of course, in the long term would be to have enough foreign exchange reserves. And yes, they have been declining. And yes, diamond exports have been under a bit of pressure. We know that global diamond demand and price has been a bit lower, but we are, of course, expecting copper production to be ramped up, and that should be helped. And also the longer term, when one's looking at shift towards renewables, then certain metals and minerals should be supportive in the longer term. It's of course taking a longer term view, not necessarily near term, but copper is, interestingly enough, one of those metals that could be very important within that shift. But even though those foreign exchange reserves, really the point I want to make here, have been declining, very comfortable still. High level of foreign exchange reserves covering imports. I think it's over 7 months expected for this year. So although declining, still very comfortable level of foreign exchange reserves for the Botswana pula. So those are just some general observations. I think I'll stop sharing, and if there are any questions, I'll try and answer my best to answer them for you. Thanks very much, Mark.
Thanks, Arthur. That was very insightful. If there are any questions, please remember to raise your hand. Alternatively, just type them through on the Q&A. But Arthur, just from our side, with you did touch on it on the sterling versus the dollar, obviously with the revolving door that was 10 Downing Street a few months ago. We saw quite a significant weakening of the sterling. And with the weakening bias on the dollar, do you think it would be a good time to perhaps stock up on sterling if you do hold that in your portfolio, if one did go a little bit short on the sterling?
So Mark, so first of all, I'm not a guy who gives investment advice, but I'll tell you what I think. I can tell you what from a personal capacity, I am. From foreign currencies, the majors, I am someone who holds more pounds than other currencies at this point. I think what's helping there and what gives you some comfort is the extent of the undervaluation. It might take quite a while for it to unlock, though. And one of the key issues there would be for the Bank of England to stick to its inflation target, to raise interest rates sufficiently to anchor inflation at a low level. It's obviously elevated right now. So I think the key issue there is that you are banking on the Bank of England to do its work. And I'm glad you've asked that question, because it gives me the opportunity to sort of mention this as well. When you look back on currency like the rand, and it gets extremely undervalued, and everybody's heading for the hills, close to 20 to the dollar. Everybody, not everybody, but a lot of people still seeking to take currency out. And then you look historically, when you've got to that degree of undervaluation, you get this long period of sustained rand strength. And there are normally two reasons for that. Lots of reasons, but very often the ones that you come across most often are: one, commodity prices go up, which just helps because you don't have to produce anything more, you just get more income and more dollars. I beg your pardon, more capital inflow, more export inflows. The other one, though, is that if you look at those periods, that's when the Reserve Bank actually started to hike interest rates. And in response to the fact that the currency weakening was starting to raise inflation expectations and was beginning to, and low inflation expectations and low inflation, as we've argued, is one of the key anchors for a currency in the long term. So the minute your central bank gets going and and is determined to hit its inflation target, it anchors inflation expectations, and that anchors the currency. I view it very simplistically. You've got high inflation in an economy, your currency is worth less. You've got low inflation relative to other countries to be worth more. And so in the case of the Bank of England, my view is that I think that they will stick to their inflation target, and that they will hike interest rates to the extent that they will anchor those inflation expectations. If they do that, then my view would be that you should see some benefit. May take a bit of a while to unlock, though, because at the moment, if you look at the UK, it's high frequency data, it's not pretty at the moment.
I'm going to put you on the spot.
You already have.
Me do it a bit more. And I think you're freezing there, Arthur. But just to put you on the spot, if we had to fast forward, let's say to 31 December of 2023, let's put some caveats in place. If the load shedding stays where it is, at a lower level, if there's no further, let's say, own goals scored in South Africa, what do you think? Where do you think the rand dollar exchange rate is going to be on 31 December? I know you've got a chart to that already.
I think by 31 December, you'll probably be more convinced that the Fed interest rate hiking cycle has topped out. I think it'll be clearer that the electricity load shedding, that the new supply coming on stream, I think there'll be a clearer path to seeing that coming online. And what I'm hoping is that, yes, I think that growth globally, especially US as well, maybe a bit slower than people think. So, but by then, with interest rate cycle peaking, and hopefully looking forward then to some interest rate relief the next year, perhaps also hopefully commodity prices bottoming out and maybe not showing an improvement, at least bottoming out, then I think that the rand will be firmer than what it is today. I think it's going to take some knocks, make one big assumption, and that assumption is that we avoid any type of sanction, especially financial sanctions. I think there's a low probability of that. So with that caveat in mind, to put a number on it, we actually fade back to PPP over a particular period, which we try and judge from how long it took the previous cycles to get back to PPP from such extreme levels of undervaluation. But it remains, I stress, something of a guess. But I've got around about, and again, I'm not going to guarantee this, and if you put a number on a currency, it's going to be wrong by the time you get there. But for what we've put in our inflation models, for what it's worth, we've got about 16.50 Rand by the end of next year, not this year. And essentially, though, that's drawing a straight line. So we don't try and really forecast near term, but we try and give a sense of magnitude and direction over time. So that's what we're working with. It won't be that, we know, but just to give you a sort of an idea the type of direction and magnitude we're looking at.
Arthur, as always, I apologize for putting you on the spot, but it's been a most informative discussion. Really appreciate your time once again, Arthur. I don't know, there seems to be a bit of a lag, and yeah, but nonetheless, thank you very much, Arthur. And as always, if anyone has any questions that you want to ask Arthur or bounce anything off us, you are most welcome to flick me an email. It's Mark Muller at Sanlam Private Wealth. Otherwise, please just go onto our website. This will be on YouTube, this webinar, so feel free if you want to catch up on anything to go and look there. Otherwise, Arthur, thanks as always. We look forward to welcoming you back in due course, if in some exotic location where you and I find ourselves traveling to. But once again, thanks very much, Arthur. Much appreciated. Thanks, everyone. Cheers.